You can pick the perfect index fund and still get this wrong, because the single biggest decision in investing isn't which fund you buy. It's how much you put in stocks versus bonds. That one split, that one ratio, quietly drives the vast majority of how bumpy your ride is going to be. Not the ticker you chose, not the clever trade. The mix. And here's the part almost nobody plans for. The right answer quietly changes as you age. Start too safe in your 20s, and you leave a fortune on the table. Decades of growth you can never get back. But stay too aggressive right up against retirement, and a single bad year can wreck a plan you spent 30 years building. So this isn't a set it once and forget it decision. It's a dial that's supposed to turn slowly across your whole life. Most people set it once, by accident, and never touch it again. By the end of this video, you'll know the one decision that matters most. Why your mix should shift as you get older. The simple rule of thumb that gives you a starting point. What the whole thing looks like across a lifetime. And the two honest caveats nobody mentions. Let's get the mix right. Before you ever pick a fund, you make a bigger choice. And most people make it without even realizing it. It's your asset allocation. The split between stocks and bonds. These two do completely opposite jobs. Stocks are the growth engine. Historically, they've delivered the highest long-run returns, roughly 10% a year on average. But it's a wild ride. In a bad year, stocks have dropped around negative 40%. That's nearly half your money, gone on paper in 12 months. Bonds are the ballast. They're the thing that steadies the boat. Lower returns, roughly 5% a year on average, but far, far smoother. They don't soar, but they don't crash the way stocks do either. Now here's the insight that should reframe everything. Research finds that this stock versus bond mix, not stock picking, not market timing, not finding the next big winner, explains the large majority of how much your portfolio swings. The mix matters more than the fund. Think about what that means. You could spend 100 hours hunting for the perfect fund, and it would matter less than the 30 seconds you spend deciding your stock-to-bond ratio. People obsess over the small lever and ignore the big one. So get the mix right, and honestly, the rest is detail. So if stocks return more, why not just hold 100% stocks forever and let it rip? It's a fair question. The answer is one word: time. Think about a 25-year-old. They have around 40 years before they need this money. If the market crashes 50% next year, that's not a disaster for them. Honestly, it's a sale. They keep buying at lower prices and they've got 4 decades for it to recover and grow. A crash that young is just a discount. Now picture a 64-year-old who's about to retire and start spending that money next year. That same 50% crash is a catastrophe. They can't wait 10 years for the market to climb back, because they need to live on it right now. The same event, completely different stakes. So the logic writes itself. The longer until you need the money, the more stocks you can hold. The closer you get to needing it, the more bonds you add to steady the ride. Your allocation should glide, aggressive when you're young, balanced as you near retirement. More growth when you have time, more stability when you don't. The dial isn't about how brave you are. It's about how many years you have left to recover from a bad one. Okay, so where do you actually start? Here's the famous shortcut investors have used for decades. You subtract your age from a number, and that gives you your percentage in stocks. Whatever's left goes in bonds. Simple. The classic version is 100 minus your age. But here's the thing. Many advisors now use a higher number, like 110 or even 120. Why? Because people live longer, work longer, and spend more years in retirement. So they need more growth to make the money last. Let's run a 40-year-old through all three. Rule of 100. 100 minus 40 is 60. So 60% stocks, 40% bonds. Rule of 110. 70% stocks, 30% bonds. Rule of 120. 80% stocks, 20% bonds. Now, these aren't laws. They're a sane starting point, not a finish line. Pick the higher number if you've got a long horizon and you can genuinely stomach the swings. Pick the lower number if big drops make you panic and sell at exactly the wrong moment. The best plan is the one you'll actually stick with. Now, stretch that simple rule across your entire life and something elegant appears. A glide path. It's the exact same idea that target date funds use automatically, every single day, for millions of people. Here's roughly what it looks like. In your 20s, you're sitting around 90% stocks, heavy on growth because you've got decades. By your 40s, you've eased back to about 70 to 80%. By your 50s, around 60 to 65%. And by retirement near age 65, you're at roughly 50 to 60% stocks, with the rest in bonds. Notice the shape. It's a smooth, slow decline, not a cliff. The slope matters far more than any single year. You're not flipping a switch at retirement. You're gently turning a dial across 40 years. And here's the beautiful part. This is exactly what a target date fund does for you. It holds the mix and shifts it down toward your retirement year, automatically, so you never have to touch it. You just pick the fund with your retirement year in the name, say, Target 2055, and it runs this entire glide path on autopilot. For life. Now, two honest caveats, because the age rule is a great starting point, not the whole truth. First, age is just a stand-in. It's a proxy for what actually matters: your real-time horizon, your goals, and your risk tolerance. A nervous 30-year-old who'd panic and sell everything in a crash might genuinely be better off with fewer stocks than the rule suggests. And a calm 60-year-old with a fat pension covering the bills might want more. The rule points you in the right direction, your temperament fine-tunes it, and the danger is highest right around retirement. There's a window, the first 5 to 10 years of withdrawing your money, that pros call the red zone. A big crash in that window does far more damage than the exact same crash at 35, because you're selling shares to live on while they're down, which locks in the losses and leaves less behind to recover. At 35, you just keep buying through the dip. In the red zone, you're forced to sell into it. Same crash, very different damage. Second caveat, whatever target you pick, you have to rebalance. When stocks soar, your mix drifts off target. A 70-30 portfolio can quietly become 80-20 after a big run, which means you're now taking more risk than you chose. So periodically, you sell a little of the winner and buy the laggard to snap it back to 70-30. That's how you actually hold the allocation you decided on. So let's pull it all together. Your asset allocation, the split between stocks and bonds, is the single biggest driver of your investing ride, more than which fund you ever pick. Stocks are the growth engine, high returns, big swings. Bonds are the ballast, lower returns, far steadier. The mix should shift with age. More stocks when you have decades to recover. More bonds as you approach the day you'll actually spend the money. Your rule of thumb starting point is 100, 110, or 120 minus your age in stocks, with the rest in bonds. That traces a glide path from roughly 90% stocks in your 20s down to about 50 to 60% near retirement. Exactly what a target date fund automates for you. But remember, age is only a proxy for your real-time horizon and risk tolerance. The danger peaks in the red zone right around retirement. And whatever target you choose, you have to rebalance periodically to stay on it. Get the mix right, and the rest really is detail. If this finally made asset allocation click and turned a scary-sounding decision into one simple dial you can actually set, hit subscribe. That's exactly what this channel is for. The money stuff nobody ever bothered to teach you, explained plainly. Next up, how bonds actually work, and why even safe bonds can still lose money in a single year, so you know exactly what the bond half of your mix is really doing. I'll see you there.